I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim, and here we are, a soggy Friday in Vancouver.
Well, it beats the snow.
Yes. Well, the snow came and the snow is going, so that's the main thing.
Yes, we have the Vancouver Snow Removal Service. Well, at work, it's called rain.
Good line.
Bob, you know, we've had the markets finish off the week strongly. Is this a trend?
Yeah, but not a long trend. We should back up a bit and note that the markets were under a lot of pressure in the fall. Well, that's what we're looking for, because the speculation in 2018 was it was as big as you ever get, and then you have to work your way out. There are some people who have a theory that they go up like that, and then they correct back and pause, and then build a plateau from which it'll go yet to ever newer highs. And that, of course, was a highly regarded professor of economics back in the late 1920s. Fisher is his last name. And he not only touted the theory, but he had his money on the line as well. And with the 1929 bear market, he suffered a lot of pain. So you can't have, positions that are resolute. You've got to be flexible. So at any rate, on our work last year was that quite likely in the fall, and mainly because there was so much speculation, that there would be a liquidity problem. And it does, and as we summed it up, that some of the bigger stocks, like the FANGs and things like that, and other stocks, highly speculative stocks, some of them took 50% hits. And the major indexes, you could say they were down 20%, and which was still a pretty good hit. And the other part was that this liquidity clearing problem would likely run into Christmas, and it kind of all exhausted itself on the 24th of December. And that's when our technical work had indeed a downside capitulation on both the S&P and crude oil. So then our view was that once that washout had concluded, that quite likely the first quarter could be favorable, and perhaps with a rally out to around March. And it's working. The first rally out of that hit at Christmas became overbought, and then the correction was modest. So I think there's a lot of short covering there on the dips, preventing a bigger correction. But these would be supported, or a rally in stocks would be supported by help from improving industrial commodity prices like crude oil and base metals, and there has been some improvement, and would be helped by improvements in credit spreads and the yield curve, and that sort of helping. But, Jim, I remember last year when we talked and mentioned we had our indicators called Friends of the Bull Market, and there were these items, and we expected them to be positive out to around mid-year and then turn after mid-year, which it did. So But on this one, we're not going to call them the friends of the bull market. They're just now friends of the rally. And the rally it's acting well. And you've had the advanced decline line improving. It's almost back to the high of last August. That's the advanced decline line on the whole NYSE index. I don't know, maybe there's 1,200 or 1,500 stocks in it. So it's an 80 line, and it's improving as well. So, but I think that the damage done with the hit to the financial markets, it's a big heads up. In the crash in 1873 in the fall, The Economist magazine then, out of London, and some anonymous writer came up with something that was really wise. So as that panic was ending, wrote, "The panic may be over, but the results of the panic are not over." And indeed, that one ended up being a 5-year bear market. And in a lengthy post-bubble contraction, indeed, the senior economist in London in 1884, they looked at how weak the economy was. Now, you would still have around the 4-year business cycle coming and going at that time, but recovery wasn't strong, and otherwise the economy was weak. And that was the first time in the literature appeared, they called it the Great Depression. Whereas at the time and earlier, if you were in a recession, what's called a recession now, the business reporters and financial writers would write it up as depressed business conditions. And then they came out with this one like the Great Depression. So that began when the bubble failed in 1873, and it ended on the last recession, which bottomed in 1895, 1896. And then you had the start of the next long recovery and long expansion in business activity. And so, but years ago when I was reading these journals of economic history, the senior economists in London were still analyzing the Great Depression until as late as 1939. They were analyzing it in the sense of how did it happen. They were puzzled by it. Some perhaps wondered what could have been done to prevent it. And so here you have this delicious irony that you had academic economists still analyzing the Great Depression, meaning the one that went from 1873 to 1895, as late as 1939. And then all of a sudden, we've got another Great Depression here. And then you went into the war, the Second World War, and everything sort of changed. But the combination, the intersection of academic economists and real markets is a never-ending source of irony.
We'll have more with Bob Hoye right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Welcome back. We're speaking with Bob Hoye. Bob, do we need low interest rates to have a healthy market? Because it seems all companies do is use that low interest money to buy back shares to boost executive bonuses.
Oh, you got the good one there, Jim. Yeah, I've written about that a few times, where the artificially low interest rates made borrowing money attractive or easy, and corporates did that. And then, of course, you had coming out of the recession that ended in 2009, the recovery was noticeably weak for years and years. So they weren't able to get the boost in earnings overall that they were hoping for. So then they came in with what you can call financial engineering. And so they buy back their stock, which means less shares outstanding, which means that with the same earnings or slightly increasing earnings, your earnings per share looked better, and of course the street was going for it. And then it got even worse, because with some of the Trump tax changes, money was brought back to a friendlier tax environment into the states, and many of the corporations kept going on their stock buybacks, although since the Trump win, and the economy became much, much stronger, unemployment at record lows, and a very powerful stock market. So they didn't have to run that game, but they got in the habit of doing it. Now, the one that really annoyed me last year, and wrote about it, just a paragraph, so you had this evil whereby companies were using shareholders' money, one way or the other, whether it's borrowed or out of cash flow or whatever, to bid up the stock, while insiders, and they have to report their positions, the insiders were selling their stock. And that really is bad financial business. It's bad. So, but also it reflects just the recklessness that goes on in a great bull market. Everybody gets reckless, but when they do it that way, that's not good business. And so when they stop, I don't know, but the changes in the credit markets and that hit, as I was saying, it could be anticipating a contraction, and that's typically what happens. Is you have the financial boom, and then it sort of exhausts itself, but what it does is signal the beginning of a contraction. And so this seems highly possible, but right at the moment, this stock rally, it can continue through March, perhaps, but we'll be watching it for a sign of excess. And this is where you put together seasonal probabilities with the reliable technical measures so that you can say, hey, this is up strongly enough that we can come out of the market, or at Christmas time where it was down strongly enough that you'd go into the market. And thank goodness we've got these measures.
Well, Bob, last year, sell in May and go away worked out. Now everybody's talking about March, so it could get harsh in March, so take a hike.
Hey, you've just given me a line. I'll give you full credit for it. Let's let this rally go, and let's hope that it concludes with a surge of excitement, which can be measurable. So that's just the way to look at it. It'd be calm. It certainly wouldn't add to long positions on this move, but we'll just watch it and see what it brings. The gold sector continues to look constructive, although it's going to have some swings. It's looking good. The thing about gold, which confounds the gold bugs, and they learned a long time ago that the Federal Reserve was evil. Yeah, I agree with that. And that their policies are of depreciating the currency. Yeah, I agree with that. But they're locked into the 1970s stuff whereby the Fed is always going to drop the dollar down and the gold is always going to go up. But they don't look at financial history, and everything seems to get a turn for speculation. So in the 70s, it was intense speculation in commodities, wholesale prices, wages. My God, everything was going up, and that drove the consumer price inflation up to, I don't know, U.S., I think 15%, and interest rates got way high. And then that blew out, and then that blew out in 1980, and then 82 bear market ended, and then that started the era of financial asset inflation. So the action shifted to stocks and bonds, and commodities and gold and silver were all left by the wayside. And then you had another then bull market in commodities and precious metals up, and that for precious metals it concluded in 2011 and it came down. But your question, Jim, was about lowering interest rates. That's a wonderful subject because in the bull market in 2007, during the summer, the credit markets began to change, get a little averse, which analysts noticed and writers. So there was some concerns about the stock market came in, and even in early September, I kept a note of it. One Wall Street voice was absolutely sure that the Fed would lower interest rates, that means short rates, and that would keep the boom going. And of course, having the history wrote against that at the time and pointed out that where you have evidence, certainly 200 years of it, is that in a business expansion and boom, short-dated rates go up because there's a demand for money. And then once the boom's over, short rates go down. And you can make maybe a rule of thumb about it, is that the fastest declines in short rates occur with the worst of bear markets. And so you had important Wall Street spokespeople in September 2007 saying that the Fed would cut rates and all would be well. But actually, as we were going into the rally that came out and ran into September, that would have been the conditions that might have prompted Wall Street pundits to say that the Fed will cut rates and all will be well, but it didn't appear then. It didn't appear until a couple of weeks ago, when actually the Fed you could see that maybe they're going to think so. So that was your question, and we wandered around all over the place, but short-dated interest rates like Treasury bills go up in a boom, and they come down in the contraction. And the other thing is that the senior central banks, such as the Federal Reserve, will follow the change in market rates of interest. But it looks like the T-bill rate in the U.S., it's not going up anymore, but it's not really going down. But maybe we can say that it looks like it's preparing to go down, and watching that one, because that would suggest that the economy in the U.S. is slowing. We do live in interesting times.
We'll be back with Bob Hoye right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, do you expect the price of gold to pick up?
In U.S. dollars, that's a hard call, because in the post-bubble contraction, the senior currency, which is the U.S. dollar, gets chronically firm against other currencies and other commodities. So I don't see any huge gains to be made in gold in dollar terms. But like if you look at it in Canadian dollar terms, oh yeah, a year and a half or so ago it bottomed and it's turned up. So the worse the currency you're in, the better you will do in gold. But for an investor, and it all comes down to production and earnings and things like that. And in the post-bubble contraction, gold's real price goes up, and that's adjusted by the rate of inflation. And then that improves the profitability of gold mining. And then the gold miners produce more, and it turns out to be the one really identifiable bull market that you can expect in a post-bubble contraction. So the entry into the gold sector has been, well, like any bottom, it's always kind of difficult, but we've got a position from early November, and but it'll swing up and down, and this is where the technical tools are very helpful. So we would be buying the dips on the gold sector, on gold stocks, as I think there's going to be more money. You get a better bang for your dollar being in gold mining stocks than you do just by owning gold itself or gold. And then, of course, you're playing futures. That's pretty wild. So we like the gold sector, gold stocks. And the entry was a little difficult, but it could be the start of a cyclical bull market.
Bob, thank you so much for chatting with us.
Well, it's good to be with you, and we look forward to next week.
My guest has been Bob Hoye, market historian and chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.